Hey guys, Max here, and this is your daily market update for yesterday, Saturday, the 18th of December. Of course, it is the weekend, the markets are closed, which gives us some time to catch up on things that happened earlier on in the week that we didn't have time to cover then. So we're going to focus mostly on developments in China and on developments with the Omicron variant. So let's just get right into it. So over in the east, in China, things are not getting any better. Shimao, I think that's how you pronounce it. Again, I'm probably butchering that, but that's what I'm going to call it. So Shimao, another property developer in China, is unable to pay its debt. It is a pretty big player in the market, but it's actually been thought of as one of the more conservative or safer market participants in recent times. So this development, that they can't pay what they owe, is really quite worrying for a lot of investors who thought the worst was over. Now, the company is big, and its total debt sits at around $100 billion, so about a third of what Evergrande owes, and by no means a small amount. But throughout the last few months, Evergrande's, Fantasia's, Cynic's, and every other troubled property developer's bond prices have been falling, but Shimao stood strong and prices kept very high and stable because investors and the company itself thought it would have no problem paying its debt. Its corporate bonds were sitting at about 90 cents on the dollar, which wouldn't be very good for an American or a Western company, but for a Chinese company, that was pretty good, especially over the last year. But they just dropped over the last week to around 50 cents on the dollar, meaning yields on their debt has basically just doubled. Now, Fitch ratings still claim the bonds are investment grade, but S&P Global ratings have already dropped them to junk ratings. The company has about $2.5 billion of repayments to make over the next year, and then multiple billions every year after that, and it's starting to look likely that these payments will not get made at all. On top of that, another developer, Guangzhou R&F, who I've actually mentioned as a firm that will collapse just like Evergrande multiple times over the last few months, well, they have just asked to delay a $725 million payment they were due to make by 6 months. They proposed this delay because obviously they don't have the money. So if they don't get any leniency, if they aren't allowed to make this delay, they will just fail to make the payment. But even if they are allowed to delay, then the problem is just kicked down the road for 6 months, and come mid-2022, I will be talking about them again when they again fail to make that payment. The property market in China is falling, which means the assets owned by these companies are losing value, their potential revenue streams are decreasing as well, and the cost of restructuring their debt is going up too. There is no, and I've been saying this for months now, no way out. Some investors have been saying this is actually far worse than Evergrande, this Shimao development, because it was so unexpected. Now, Evergrande was always known to be very highly leveraged and risky, even as far as Chinese companies go, but Shimao was supposed to be a blue chip developer, stable, reliable, and sensible with their debt and growth. There was this idea present amongst lots of investors that all of these collapses would be contained to the worst offenders, the companies that were stupidly over leveraged, but of course those people were wrong, as any frequent viewer of the channel can tell you. This is actually a form of contagion as well. The risk is spreading out into more reliable firms, yes, in the same industry, but firms which just a month ago we were being told were entirely solvent and had bright futures. Now, in my opinion, we can expect this trend to continue. House prices have now fallen across the country for the third consecutive month, falling between 0.3 and 1% each month, and by no means is that a good sign. Every day, news emerges of another firm destined for bankruptcy, and as I said earlier, there is no way out for these companies. This is just the natural second part to a bubble. After a monumental rise, there is a catastrophic crash. And in the entire history of mankind, there has never been a bubble that lasted forever. They always crash, and that's what we're watching right now. As to how the environment will look after the crash, or what the CCP will do to try and tame it, no one really knows, because the CCP act in a vacuum and aren't answerable to a population in the same way a democracy is. My prediction is that we see soft nationalization of most of these firms that go bankrupt. The CCP or local governments will take control of the development projects, they will complete them and try to turn a profit, though they will most likely fail. After a few years, the vast majority of property developers will see some, if not all, of their parts nationalized and under CCP control, and the entire industry will be effectively nationalized. The CCP will probably try to stop Chinese citizens from getting stung here, but they won't be too successful as there just isn't that much they can really do to stop property prices from continuing to fall. China's problems aren't only in the property industry though, as we've seen more issues come out this week. Firstly, one of China's largest semiconductor companies, and one that is actually very important, has had a rescue package rejected. Basically, the company, and I'm sure you won't be surprised when I say this, it has too much debt. Shock horror, I know, a Chinese firm who financed its growth through irresponsible borrowing. Well, we've never seen that before, have we? Anyway, a government takeover bid was made to try and save the company, but a major shareholder pushed back against this deal and rejected it. Now, you might think that the problem was that, again, this would probably lead to soft nationalization of the company, as the CCP would basically just take control, but in reality, the shareholder just isn't happy with the value the company has been given. They want more money in return. Now, I'm really not sure how well this negotiating style is going to go down with the CCP, and in the end, the result will probably be the same. Government control will be extended and the debt will be secured by that government. But the important thing here, at least in my mind, is how the investors are treated. Now, I've said time and time again that investing in China is an awful idea because the chances are you will get burned by the CCP, and if the CCP insists on this valuation and they just force it through because as an authoritarian state they can do that, well, it would be a bad sign to all future investors and push capital away from the country. This is the exact same thing that has happened with Tencent and Alibaba over the last year. The CCP has attacked these companies, and lots of investors have decided the risks are not worth the rewards, so they just left the market, and suddenly there is less capital to finance growth, and this will hurt China's economy in the long run. The risk to investors in Chinese stocks from US regulatory authorities is still a threat as well, and one that has been growing too. This week, the US announced that another 7 Chinese firms were to be blacklisted by the US, which is on top of SenseTime, the AI company that was blacklisted last week. Now, I covered SenseTime when that news came out last week, and I said that there was more to come, and of course there is more to come. Chinese and US relations are not going to get better. They are going to continue to deteriorate year after year after year, and Chinese stocks will deteriorate as they struggle to interact with the Western economies. China's largest chip maker took a big hit on this news and fell 25% in one day. Pharmaceutical companies were hit as well, and a couple of them dropped over 5% in one day. This all came just days after I read a Bloomberg article telling us all about the huge deals available in the Chinese market, and it's just astounding to me how clueless these fund managers are to the reality of geopolitics. Now, to be fair, I don't really believe that. I don't believe that these fund managers are clueless. The problem is they don't actually care if they make or lose you money as an investor. They care that they get their fees, and they can charge higher fees for actively managed funds in countries like China, so of course they're going to push Chinese stocks to you. I don't really believe that they're all as brain dead as they seem, but they are trying to sell you a falling knife in order to profit themselves. I read another quote from an investor yesterday that said, "It's an extremely painful drop, and until we know more details, it's hard for us to take any action." Well, guess what? That's a lie. The action they could take is just not invest in Chinese stocks that are complicit in genocide and are going to get sanctioned by the US authorities. Now look, none of this is financial advice. You know the drill on YouTube. I can't tell you what to do, but I can tell you that there is no way in hell I will invest a penny into the Chinese market right now for a myriad of different reasons. But even if the property market weren't crashing, which it is, and even if the economy weren't slowing, which again it is, I would still not invest in China for one huge reason. China and the US or the West are enemies. This is the start of a second Cold War that probably won't be fought in proxies in Vietnam or Afghanistan, but over stock markets and trading floors. The West and China will decouple from each other's economies over the next few decades as sanctions are passed, trade is reduced, and capital stops flowing. One side will be characterized by innovation, capital markets, and wealth creation, and the other side will be characterized by authoritarianism, state-run industries, and excessive control. Now with that, I think we've covered China for the week, and it's time to look at the Omicron variant and the developments regarding that over the last week. Now the news regarding this have of course been pretty negative, and fears have re-emerged that have impacted the markets. Cases are rising very quickly, pretty much everywhere, which was mostly expected, and this isn't actually hugely worrying in and of itself. The problem is, in certain countries, certain media outlets have been using case numbers as fear to drive their agendas, and nowhere is this more true than in the UK where I live, with the BBC and other outlets like The Guardian. They've been ecstatic about this news and pushing very heavily for restrictions and even lockdowns, to be honest. Restrictions are already in force, but it does appear as though the Tory party, the current government, doesn't want to go any further, and it seems that these restrictions are mostly there just to appease the media, as they really don't make much sense. For example, if I walk into a pub, I'm allowed to drink a pint without a mask as long as I'm sat down, but if I stand up, I have to put on a mask. If I stand up and drink, I have to keep wearing a mask. If I walk in or out of the pub, I have to wear a mask. But when I get to the point where I sit down on a chair, suddenly I can take it off. This makes no sense. It's not going to reduce any spread. It's just there to appease the media and the fanatics. Again, as I've said before, culture varies by country, and Europe in general is just more fearful than somewhere like the red states in the US, so this was always a little bit expected. Cases are soaring all over mainland Europe, and they're going to continue going up for a while. Lots of travel bans are in place, but again, this really won't stop the virus spreading at all, so it's all just pandering to the media and the populace. All of these fears, I think, are mostly unfounded, as case numbers themselves shouldn't drive policy, especially when considering the discrepancy between the way countries test. There are, though, actually some bad-ish developments. Again, this is all early data, we're still not 100% sure, but it seems like hospitalizations are rising quicker than we expected, especially considering how thoroughly vaccinated Western populations are. And also, lots of people are getting seriously ill from the variant, even if double or triple jabbed, even if they aren't getting to the point of actually being hospitalized. The savings grace here is that deaths are very low, and that is the most important metric in my mind. Markets are pretty unhappy with these developments, but even more so, they're unhappy with the way the media are covering the developments. Media drives people's opinions, and that drives policies, and the markets are predicting restrictions that will impact economies because of the way the media are fear-mongering here. Now, if you want really solid, reliable, and honest information regarding the virus and all of the developments that come, I'll direct you over to Dr. John Campbell. He goes really in depth. There'll be a link down below in the description. He knows what he's talking about, and he's probably the best source of information out there regarding everything on this topic. And from this point on, I'm pretty much just going to be using him as my base for information regarding the virus. But we do need to remember that most people won't listen to him. They will listen to CNN or BBC or France 24, so the markets won't always react rationally. That is pretty much it for the day. Thank you for watching. I'm not sure if I'm going to be able to get a video out tomorrow. I have to travel a bit, but I'll see what I can do and hopefully get something sorted for you all. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like private live streams, extra videos, and buy and sell alerts for my own personal portfolio. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. There's also a link in the description to BLOCKFI, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you'll get from any savings account these days. Just make sure not to use Tether. Thank you all for the support. Thanks for watching. Stay stoic. Until next time.